What is up, everybody? It's Stacks by the Numbers. Welcome back. And as per request, we're taking a quick look here at Clear Secure Incorporated, ticker symbol YOU, listed here on the New York Stock Exchange. Now, I see that the company recently reported earnings and had a pretty nice pop on another beat. The stock, I cannot deny them. The stock has been very consistent here over the last couple of years, really. If we go back, we look at the history. But this company basically does biometric scanning, I believe. And as you see here, identity company developing biometric identity verification, and it says they use it in healthcare industry and at like stadiums and whatnot. So apparently it has been just consistently requested by these venues, if you will, and it just basically kind of just consistently keeps snowballing. And if we come back looking at some previous earnings, you can see we were down here at 80 million, but we beat on the top and bottom line, and we just continued to keep seeing that growth in business here. Up to 90, breaks above 100, stays above 100. Look at that, 128, 132, just consistently. Look at this, 149, 139, up to 160 now, up to 170, almost 180. And now this last quarter that came in, you can see they pumped up estimates to almost 184 million, and the company comes out and posts almost 187 million. So, but while at the same time they've been beating on the EPS side the entire time. So this company right now seems pretty steady, pretty consistent. And in my opinion, if we look at some of the numbers, we may have some red flags that could potentially show us that a sell-off could be coming. However, even looking at something like FinViz, if we pull up the symbol, you can see that still has over about 20% of the float shorted, and of course came out and beat earnings. This was August 6th, so about 2 weeks ago. And you can see that we came up and we're kind of right at one of these trend lines here that I drew out. And also, if we connected some of these tops here, you can see this trend line sitting at about $35, which would still be about another 25% move from where we're currently trading. So with the good numbers coming out and the big pop taking place, as you see, the stock actually started to sell off here, was consolidating upward, broke down, and as you see here, the low, it was down here at 1823, and then just spiked up on this beat and ran to about 29, as you see, hitting new 52-week highs, 28.86. Stock closed just over 28 right now, and in my opinion, if it does get above this trend line, then we could see $35. And because of the float being shorted, I think it might happen before we see a potential rejection, and then we start to pull it back down to earth. Because in the numbers, it does seem a little rough, but let's take a look at what we're seeing here. We have a market cap of about 4 billion. The company just recently started paying out a dividend, as you see here. There's a couple of special dividends mixed in here along the way, but now as of 2023, the company started paying out dividends to shareholders, and we can see we're currently getting a dividend that's yielding just a touch below 1.5% here based off current stock price. We're trading a touch below 36 times earnings, and we have a float 76 million shares, but we can see the consistency. Right? We can see the company right now, obviously net income positive, and they're coming in well above these expectations here, 30, 60, 70%. And next quarter, we're expecting 33 cents a share. The company just reported 34 cents a share. So if they can keep going down this path, then chances are they're probably going to report 35, 36 cents a share, and it could be another potential beat 3 months from now here, mid-November, it looks like, on this EPS side. But even on the revenue side, we can see annually, we had some decent growth here going into 2020, getting above 200 million, and we just continued that growth and apparently really catapulted just over the last year or two. And we can see we got up to a touch over $250 million, and then we spike up in revenue to 437 million, and now over 600 million to close out 2023, with the company also having a positive net margin, as you see, of around 4.5%. So technically, the business is growing nicely. And if we switch over quarterly, we can see that steady growth. Again, we looked at it over here. We can see that steady growth coming in, and also the net margin is kind of following suit. Spiked up to 9.5%, pulls back, stays above 8, and then just consistently keeps climbing. 10.5%. As of last quarter, almost 13% net margin. So technically, all of these numbers are moving in the right direction. The one thing that really catches my eye is the equity itself of the business, and I'll show you that right now. And if we look at, again, we can see it's the consistency, right? It's the consistency. Because again, in the numbers, I understand, in my opinion, why it could have been viewed as overvalued right out of the gate. As we said, a lot of these IPOs are, right? This is a company, again, we're talking mid 2021. And if we come back, 2021, look, they ended up closing out 20. We didn't know that at the moment, right? Because it went public June of 21. But we ended up closing out the year of 2021 making about 250 million, and we lost about 36 million to do so. And here at 28, we have a $4 billion market cap, which obviously means when we were up here, we had an $8 billion market cap almost right out of the gate for a company doing a couple of $100 million in revenue and operating at a loss technically. So this is why, to kind of just have this in this downtrend for this whole time, basically, in my opinion, kind of makes sense. But you can see that we had some excitement coming out of the gate. Looks like maybe potential head and shoulders here after the first couple of months. We had the breakdown. Then you can see that we were sideways for quite a while. Then we ended up breaking down, and we just continued down this sell-off path. You can see I drew out a trend line here connecting the tops of August 9th, it looks like, 21, coming down to that top right there. It looks like February 3rd, 2023. And that cuts down and cuts across, and you can see it basically met up with this recent high going back to the end of March of this year, and the stock obviously broke up above that, pulled back below it, and then we had the big earnings beat and the stock spiked up. And this is why I said, if we look now at the trajectory, the current trajectory of the stock, you can see that going back to these previous tops when we were kind of sideways here, you can see that this top is about 3090, 3096, 3080, and this top right here 3085, 3075. So this is why I'm saying we could potentially have a breakup above this trend line and get back to these high 3070, 3080 levels. But then if we get above this resistance trend line and we get back to these highs, this is why I'm saying with the short float still sitting at 20+%, we could potentially have a pump up to 35 before we have a rejection and start pulling back like we had on multiple occasions over the last 2 years, really, throughout 22 and even 23. So here in the immediate short term, we could still have some room to go. But in my opinion, I do think it's overvalued in the numbers. And if we look, we can see we do have a lot of positives. Again, I'm not necessarily trying to bash the company, but it does seem a little overvalued. But again, this is just my opinion. But the debt, you can see 130 million, and it's been slowly and steadily ticking down, now sub 125 million. So that's heading in the right direction. The free cash flow here, 110 million. That is the highest it's been going back the last 4 or 5 quarters. And the cash on hand kind of seems to bounce around. It was sitting between the high 50 and the mid 60 millions. Now it's sitting down here at 39 million. So, something to keep an eye on. But technically it's down, but the free cash flow is up. But the debt is slowly coming down also. So this is why I'm saying it is more positive than negative. But if we look at the balance sheet itself, we could potentially see a stock that can have, like I said, the spike up to the 30s and then an immediate rejection and start to pull back to the low 20s and the high teens to where it was. Assets technically outweighing liabilities in both the short and long term, and this is what I wanted to show you. So as revenue and profit margins and everything's growing consistently, apparently the actual balance sheet appears to be shrinking. And what we see here is we have assets over 1 billion, and you can see the spike up to 1.09 billion, and then it's been steadily declining down to sub 1 billion now as of last quarter. But look at the the liabilities, excuse me. Liabilities are up roughly 50% over the same period. That assets slowly came down. So we're kind of trying to maintain like that billion range on the asset level, but the liabilities have just started to creep up like crazy over the last couple of quarters. And now technically this may lead to future revenue, right? But if we look at the quote unquote fair value of the business, and if we can make the argument that it's either fair valued or slightly overvalued in the moment, then what can happen is we can have that sideways, excuse me, that sideways effect again, potentially. And you saw how the stock went sideways for like a year and a half. So this is why I say when stocks get too pumped up, even if it's on good news and consistent positive catalysts, you may see a period where for 6, 8, 13 straight months, the stock really just kind of stays in a tight range and doesn't have the ability to break up higher because we've already gotten to a higher point. But looking at the equity here, we can see at the tail end of 22, equity was a touch over $500 million. Now we're down to sub $250 million. Right? This is the red flag that, in my opinion, I'm seeing here. Technically, the business, again, is growing nicely. All the margins are up. Revenue, profitability keeps consistently climbing. They keep consistently beating estimates. So, as we said, comparing it to something like an NVIDIA, when you see just consistent positivity, that is what really feeds and fuels a big stock rally, which is why I'm saying I understand if it breaks up into the 30s from this point and continues to make new highs off of another earnings beat. But in the numbers, we may have a problem here. And again, as you see, the liabilities are up about 50% over these last couple of quarters. Equity is down over 50%, down to 228 million. The debt, again, slowly coming down, not really an issue. Book value per share down 50% over the same period. So that's what I mean. Right now, technically, if this company had to close its doors, liquidate everything in its name, looking at about $1.65 a share. Stock right now trading at 28. So we are trading at a high price to book multiple here. You can see the PE was down into the 20s. Now it jumped back up, right? Got to almost 36. We were pulling back and coming down to earth. And you can see the PE was about 37.5 before it dropped even lower. So this is why I'm saying we might like retest that climb on the positive news, on the short float, and we might have the volume consistently coming in, and we can see 30.70, 30.80, 31, maybe 35 at that trend line. And then we may reject and start to pull back down to earth. Price to sales sitting here at almost 4. That's the highest it's been going back to mid 23. And it was pulling back to about 2.5. Price to cash flow now has jumped about 50% quarter over quarter, went from 6 times cash flow up to 9. And remember, the cash flow jumped up to 110 million. So on that rise, we're still trading at a higher multiple, really going back like the last 5 quarters from the last time we had that ratio. Price to book now trading 17 times book, which is about 100% higher than where the stock was when it was kind of just hanging out in that sideways moment. And the enterprise value, again, which is what another company would be willing to pay for this business, after this pump up and another positive earnings report, you can see the enterprise value right now is sitting at $3.5 billion, and our current market cap is over $4 billion. So this is why I'm saying we can potentially keep feeding off of this momentum and off of this earnings report, but if we do start to pull back and all of a sudden we take like a 15% haircut from this level, in my opinion, I wouldn't be shocked, and it kind of makes sense. So right now the stock's at 28, and I know it's another beat, and I know people might be pumped about it, but in my opinion, this stock realistically should pull back to the low 20s, if not the mid to high teens. In my opinion, I would wait for a pullback, and I understand I'm coming to you late and the stock just dipped down going into earnings, but we know that earnings are a gamble. Even though the company had the consistent beats, in the pro column, if you will, on the back burner, they had that to feed off of. So if you basically bet that the stock would beat earnings again, I mean, you had a pretty high probability to do so. However, based off of recent earnings reports, even as they consistently beat earnings, the stock was consistently dropping down. So obviously, if you got this one right, congratulations. However, we could have seen, for all we knew at the time, we could have seen another earnings beat and another stock sell-off. So we know that nothing's guaranteed. However, it seems like they may have bottomed out the stock and started to climb it now off of the recent earnings report. But we can see all of our return percentages are up. Our gross margin percentage climbed up and touched above 61%, which is technically the highest it's been going back the last 7 quarters. The operating margin climbing very nicely as well. Look at this, was minus 25%, turns positive, double digits, sub 10, back up to 13, back up to 16.25% now, the operating margin. This is why I'm saying, technically, if you look at all of these numbers, there are many more positives than negatives. What doesn't what strikes me as an issue is the rapidly rise in liabilities and the rapid decrease in equity. That is, in my opinion, the massive red flag with this company, because technically everything else, as you see, is growing and is moving in the right direction. But I feel like the stock technically can't explode because that balance sheet keeps slowly trickling down in value. That's why, again, I know I'm late to the party. A lot of people may like it, and that's why I'm saying we may kind of continue to fuel off of this momentum, and we could break into the 30s, maybe 35 at that trend line. But then realistically, the stock really should start pulling back, because as good as these margins are growing, technically it appears that the business seems to be shrinking on the balance sheet. But again, that's just my opinion. EBITDA, same thing as you see, negative, swings to positive, and basically just consistently keeps growing. EBITDA almost up to 20%. Net margin percentage we looked at before, slowly negative, climbs back positive here, 9.5%, 8%, up to double digits, and as of last quarter, almost 13%. So this is why I can't necessarily completely bash the company, because they are obviously doing a lot of things correct. My main red flag is that rise in liabilities and the steady decline of the equity over the last, 7 quarters. Asset turnover, again, how much revenue the company generates off of said assets on its balance sheet. The assets, as we saw, was a touch over $1 billion, now pulled back to the high 900 million. So the assets haven't really moved too much, but the revenue is consistently coming in. So we can see the asset turnover just consistently increasing quarter over quarter, going from 0.47 up to 0.67, which is really phenomenal growth there. This is why, again, it seems to be a growing industry, but at the same time, it seems like the overall business is kind of, I don't even want to say dwindling away, but at the same time, again, we kind of have to call it like we see it. And having that equity go from, plus $500 million down to 228 million or whatever it was, I mean, in my opinion, that's not quite adding up, but I may not have the full picture here, which of course is what the comment section is for. You guys to call me out and say, oh, you don't know what you're talking about. They did this, this, and this. That's why. So, I'm hoping there's some piece of information like that justifying and explaining the rise in liabilities and the drop in equity. Because technically, when we see companies, for the most part, consistently grow the business and consistently have revenue come in year over year, quarter over quarter, you kind of slowly see the buildup of assets, but it is outweighing liabilities, right? And they're able to consistently tick up the equity quarter over quarter, year over year. So technically the business is growing nicely. And that's why I see that the revenue is here. I see now the profitability is here and growing nicely, but the balance sheet just seems to be suffering. And again, the debt hasn't really moved, even though it is technically going down quarter over quarter, which, technically is a good thing. But we can see that the assets haven't moved much. So our debt to assets ratio is essentially flat. The equity consistently keeps dropping, right? So our debt to equity ratio went from 0.44, 0.45. Now it's above 0.8. So we have an 80 plus 90% increase in our debt to equity ratio over the last couple of quarters. Long-term debt to total assets, again, assets haven't really moved much. So you can see that it basically maintained this 0.12 level. But long-term debt to total equity, again, the debt is basically remaining the same and the equity is slowly going down. So that's widening our debt ratios here. And you can see we were down at 0.42, 0.43. Now we're almost up to 0.8. which would translate to almost a double, almost 100% move in these debt ratios. So that's why, in my opinion, I am a little skittish about not necessarily saying that I wouldn't buy into this stock, because as we saw, again, revenue consistently growing, right? So that's a good thing. The problem, again, they're looking at the rise in liabilities, the stagnation of the assets, and of course, the consistently declining equity. In my opinion, I would wait for a big pullback. I would wait for a big pullback. And I know people are going to say, well, it just pulled back to 18. Now it's at 28, right? You missed your opportunity. Let me tell you something. In my opinion, it may still be overvalued even at 18, which is why they brought it all the way down to, the low 15s. Yeah, in my opinion, that may have been realistic. It may have been realistic. But now, if everyone's kind of getting this trending, and again, we still see the short float above 20%, this is why I'm saying we can maybe take that next leg higher, break up into the 30s, but it may be very, very short-lived. Because technically, in my opinion, the fundamentals don't look very strong. And we can really start to immediately give back these gains that the stock saw just over the last couple of weeks. And of course, if markets actually correct and finally come back down to earth, something like this can get completely smacked up. Which is why I always talked about pricing and timing and trying to wait for, a good price and a good entry. But we know that it's unpredictable for the most part. But yeah, the company recently started paying out dividends, which is a pretty good sign. And if we look here, looking at the earnings, we can see this is the consistency that we were talking about. And of course, if these numbers were a little bit higher, if we're talking, 270 to, 379 million, then yeah, the stock would absolutely be running like an animal. But the problem is, as consistent as it is, you can make the argument that it's overvalued. But I have to give credit where credit's due. I mean, the profitability is consistently climbing, beating these estimates. The revenue growth, absolutely phenomenal. I mean, look at this, Q4 22, now we're mid 2024. So over the last 6 quarters, that's only a year and a half, revenue is up roughly 50% from 128 million to 186 million. So this is why I'm saying the company's absolutely doing something correct. But seeing the consistent decline in the equity raises a red flag for me, in my opinion. Even on the annual side, the company has been coming in above estimates right out of the gate. You can see biometric scanning, basically their main product. Big explosion here. Revenue up roughly 200% from 2021 now going into 2023. All business out of the US. But yeah, it's just not adding up to me. It's not adding up. And if we look here, let's do something, right? Try to find our quote-unquote fair value. So debt down from 130 to 124 million, equity from 510 million down to 228. And it's funny, right? Because when I speak about some other smaller cap stocks that I like Fubo, and I think maybe Roku kind of has a similar. And who is the other one? Mo Inc., right? POW, POWW. You see that you see the stagnation on the balance sheet, or you see the declines, and you see the slight drops in the book value quarter over quarter, and people try to make the argument, oh no, Fubo is struggling, it should stay down. Oh, POW is struggling, it should drop and hit new lows. But something like this, again, we have basically the same exact situation, and people may be more bullish on it than those other companies. Which is kind of why, again, I say that, if you're going to have a rule like that, it has to be, across the board for almost every company. That's what makes it a rule. And if there are now too many exceptions to the rule because you own them or because you like them, well, guess what? Now it's not a rule, is it? But technically, 228 million, debt 124, so that would bring the equity down to about 100 million. And if we go by last year's numbers, 613 with 28 million. So if we add those up, you're looking at about 640 plus our 100 million would be 740. And we have 39 million cash on hand, so we're at 780. 780, which would right now be about 5 times quote unquote fair value, which may be viewed as in line or potentially overvalued, because we looked at a lot of other stocks that are trading, 1.5, 2 times fair value. And now we have a company here with consistent declining equity that's now up to 5 times fair value and a PE of almost 40, especially if we break up into the 30s, right? So now we're going to spike the market cap up to 43, 45 billion, and the PE is going to jump up to 40, 42, 46. And this is why I'm saying it may be very, very short-lived. I like the dividend. I like the fact that the debt is slowly decreasing. I like this free cash flow jumping up to above 100 million, right? That's the first time it did that over the last couple of quarters. Significantly better than where it was this time a year ago. You can see free cash flow 66 million. Now we're at 110 million. But also at the same time, people have been looking at how much cash a company has on hand dealing with the hyperinflation and the higher interest rates. And that's why we said that a lot of tech companies may consistently get rewarded just because their profit margins are so high and they're sitting on, hundreds of millions of dollars and billions of dollars in cash on hand. So even if the economy stays rocky or whatever the situation may be, they'll be able to stay afloat and not take too much damage because they have all that cash to kind of cushion the fall. So if we're looking at cash also, we can see it was 57 million cash on hand this time last year. Now we're down to 39 million, technically the lowest it's been the last 4 or 5 quarters, right? So this is why I'm saying we have some positives, we have some negatives. The growth can't be denied. The dividend is a good sign. The consistency of the earnings is a great sign. Consistently seeing things like the operating margin, the gross margin percentage increasing, that is a great sign. This is a bad sign. This is a bad sign. And in my opinion, it's not adding up right now. And that's why I'm saying again for the nth time, because I love to repeat myself and talk for too long. But this is why I'm saying I think that we could potentially pop up into the 30s, and then it may be short-lived and we may kind of pull back. First level I'm looking for is here, about 3070, 3080, and then we could potentially break up here to about 35. Again, kind of going back to those tops of, where was that? February 3rd and December 30th, 2021, it looks like. But if we switch over to FinViz, we can see, I'm sorry, there you go, let me turn that off. But we can see that we have a short float here, still sitting at over 21%. So in the moment, this is why I'm saying, off of this big spike and this volume coming in now, we can potentially see the breakup above this trend line and spiking back up to the 30s. And this is why I like trend lines as well, because even if you cut them, look at this is kind of going right across the graph, right? Right across the chart, excuse me. But you can see this is a trend line from the bottom of March 15, 2022, and I cut it across to this bottom right here of May 9th, 2023. And it's, cutting across as it's coming down. But now you can see on the way up, and look at that, it's basically right where the stock stopped and started to reject and pause a little bit. So again, they're never always going to be perfect and always guarantee any move. We know that nothing is guaranteed. But this is why, again, I like to draw out a lot of these trend lines, because you can see where a stock could potentially run up to and maybe have to pause and see a rejection, or you can see where a stock breaks up above and closes. Right now we're bullish, so now we may be on the way to the next trend line. And again, I know it sounds silly, but if we go back to something like Rolls-Royce, when I broke down all of those trend lines and all of those price levels I was expecting on the rebound, I mean, we've been hitting one after another now for the last year and a half straight. So again, everyone kind of does their own thing, but I like looking at the trend lines, but I try to look at numbers and everything else. But short float up here still 20+%. So this is why I'm saying we can potentially break up above 30 plus. But the RSI has been up, excuse me, above this 70 benchmark basically since the company reported earnings. And this is why we can maybe see a cooling here. But top Bollinger Band now trumpeted up to above 31. And what was the level we were looking at before? About 3070, 3080, top Bollinger Band 3104, right? So we can have that spike up and then potentially reject and start selling off. So we have to see. But the MACD also obviously spiked straight up with that B line. And now we can see potential curling and maybe coming back to the downside. So we have to keep an eye on this as well, because if the RSI starts to come back down to earth, middle of the road there, the 50s and the 40s, that's going to cause the MACD to cross back to the downside, which could potentially come back to like here, right? Even if we draw our line across the bottom here at support level of the MACD, you can see that that would be like here, right around 1. So we can cross, and you can see our top MACD is at above 2, and the bottom's at 1.9. So that's why we can cross, and we can potentially have a big sell-off, which is why, again, I'm saying like a 20% haircut back down to like the 24s here, mid-Bollinger Band range. It may happen. It may happen. But we have to see. The RSI on the weekly, pretty overbought as well. You can see we spiked straight up to that 70-plus benchmark, and we've been holding there now, basically since earnings. And our top Bollinger Band, 2663, we trumpeted, of course, on the big spike up, which is why we may potentially pause and start to give back some of these gains and wait for the Bollinger Bands to curl, top and bottom, tighten up, right? And then we may potentially rise and continue to climb off of this good news. But here, this mid-Bollinger Band, 1972, 50-day moving average, excuse me, 50-day moving average, 1932. In my opinion, that's where the stock should be, even after a big beat. Because, again, consistent revenue growth, those margins climbing, I mean, all of that cannot be denied. Equity, now we're talking about 200 million. Book value took a 50% hit over the same time frame. And again, it may have been a little less consistent for as long, but something like Fubo, that's what I mean, same thing. You know, where you can technically see the trickling down of the book value, but the company has been consistently growing their sub base and consistently beating earnings on EPS and revenue. So kind of a similar situation. And that's why, you know, some people may hate on one, but like another. I mean, of course, you know, biometric scanning. So if you feel, you know, the government's going to take like full control and eventually roll this out literally everywhere, and, you know, it's going to become, you know, a part of everyday life, then of course I can appreciate where you're coming from. And the growth seems to be potentially showing us that, right? Which is why I'm saying, as a stock, it's interesting, and we can potentially break up into the 30s. As a business, this company should be trading like 50% lower in value than where it's currently trading. But again, that's just my opinion. But if you got in recently off of these earnings, or if you've held it for a long time and you heard they're doing this or they're trying to do that, let us know down in the comments section below. If you kind of know a little bit more of the backstory than I do as to why liabilities have been climbing and equity has been consistently declining, let us know that in the comments section as well. We talk about, here's some insider selling shares. Clear Secure maintained that buy at Goldman. Price target from 27 to 31, right? So that apparently we're seeing this 31 level in a lot of places here. Maintain, outperform. Man, price target maintained with a 34 per share. Price target maintained 40 a share by Needham. So it seems like everyone's pretty bullish on it. And this is why I'm saying I can understand why. But at the same time, we don't want to get tied into a potentially overvalued stock at an overvalued price if this sell-off does inevitably take place. I know a lot of people are circulating, you know, previous charts comparing back to 2008, and they were saying that we could potentially be in a very similar type of market cycle, where we're going to maybe continue to pump for the next couple of weeks. And then if we do happen to get rate cuts mid-September, like we did that, you know, all those years ago, that's when the market started to sell off and really started to pull back. So that's why I'm saying, looking at the business itself, if something like YOU has the potential to go from 28 back to 18 or down to 15, right? If you buy at 28 and then markets sell off and get rough for the next 12, 18 months, well, guess what? That's how long you're going to have to hold, and then some, until you potentially get back to break even or profits, right? That's why we always talk about pricing and timing. Is it a good growing stock? Yes. If markets start to sell off, could it drop hard? Yes. If it rejects here now and markets stay the way they are, can it drop down to 17? Yes, in my opinion, yes. Wedbush raises price target from 20 to 24, remains neutral, right? Because now we're above that level. Share surge after upbeat result. Company reported net income 34 cents a share, up from 15 cents a share earlier. That's what I mean. All of these numbers are growing phenomenally well, which is why, again, seeing the equity consistently decrease, something's going on. Revenue for the quarter was 186.75, up from 149 a year earlier. Phenomenal. For Q3, the company expects revenue of 193 to 195 million. Analysts were expecting 187.9. So apparently they're really branching out, and they're able to generate more and more revenue consistently than all analysts are expecting. Yet it's not translating to the balance sheet. So I kind of like it, but I don't like it. Hypothetical situation, if you gave me, I love how as I'm doing this, there's a fire truck going by. But hypothetically, if you gave me 100 grand right now, let's call it, nice round number. If you gave me 100 grand, the question, would I buy YOU? My answer right now is no. But that's just me, that's just my opinion. And again, if you have any other insight, any reason why some of these numbers are declining, or if you see continued growth on the horizon and you feel that the stock may continue to grow over the next 12, 24 months, please let us know down in the comments section. And of course, like I always say, if you jumped into this stock a while back, or if you recently bought before earnings, let us know in the comments section, kind of what the position is, when you bought it, but of course, more importantly, why you bought it, right? Like we always say, the why is more important. But that's pretty much it. I spoke for too long, so I'm going to end it there. But once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they're volatile, and they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for your time. Have a good day.